2014, Steve Ballmer, the former CEO of Microsoft, did something that made the entire financial world laugh. He paid $2 billion for the Los Angeles Clippers. At the time, the Clippers were the junior varsity team of LA, overshadowed by the Lakers and coming off a PR disaster that had forced the previous owner out. Critics called it the ultimate ego purchase, a tech titan with too much cash, buying a shiny toy at a 300% premium. But today, that overpriced toy is worth nearly $5 billion. How does an asset that technically loses $50 million a year on the balance sheet make its owner $500 million richer by the time he wakes up on New Year's Day? This is the central mystery of the billionaire's playground. We are taught that businesses exist to generate annual profit, but professional sports teams play by a completely different set of physics. For the world's elite, a sports franchise isn't a business. It's a sovereign wealth fund, a massive tax shield, and a legal cartel. To understand why losing money is the smartest investment on the planet, we have to look past the scoreboard and into the ledgers. The entry fee for this exclusive club is designed to keep everyone but the 0.1% out. If you wanted an NBA team 20 years ago, $300 million might have done it. Today, you don't even get a meeting without $3 billion. This extreme scarcity creates a price floor that essentially never drops. There are more plutocrats than there are teams, and as long as that supply and demand curve stays broken, even the worst managed team in the league will eventually sell for a record price. You aren't buying a company. You are buying a seat at a table where only 30 people in the world are allowed to sit. While the buy-in is steep, the league itself is designed to make sure you never actually fail. In any other industry, if your competitor goes bankrupt, you win more market share. In sports, if your competitor dies, you have no one to play on Sunday. To prevent this, leagues operate as a form of corporate socialism. Through revenue sharing, the giants like the Dallas Cowboys or the New York Yankees are forced to cut a check to the struggling teams in smaller markets. This guaranteed safety net ensures that no owner ever truly hits rock bottom. Regardless of how many games they lose, that safety net is anchored by the most lucrative product in the history of media: live sports. Every few years, television networks and streaming platforms engage in a bidding war that sounds more like a government's national debt than a commercial contract. These corporations are desperate because live sports is the only thing left that people won't fast forward through. Because of these deals, many teams receive hundreds of millions of dollars before a single fan buys a ticket or a hot dog. In the NFL, every team is essentially profitable the moment the television contract is signed. But if the income is so high, why do these teams constantly report that they are losing money? This brings us to the mid-video payoff, the most powerful legal loophole in the world of finance: the roster depreciation allowance. In most businesses, you can depreciate a tractor or a factory over time as it wears out. In 2004, the U.S. government decided that a sports team owner could treat their players exactly like those tractors. This is known as the Bill Veeck rule. When a mogul buys a team for, say, $1.5 billion, they are allowed to write off nearly 100% of that purchase price over a 15-year period. Think about the math. That's a $100 million tax write-off every single year. Even if the team actually made $50 million in real cash, the owner can tell the IRS they lost $50 million because of this artificial depreciation. They can then use that loss to cancel out the taxes they owe on their other, more profitable businesses, like their real estate empires or hedge funds. The government is essentially subsidizing the hobby of the ultra-rich. Despite this get-out-of-jail-free card, the game isn't without its casualties. The risks are real, and they usually come from over-leveraging the future. Look at Leeds United in the early 2000s. They spent millions they didn't have on player salaries, betting everything on qualifying for the Champions League. When they missed the cut, the entire financial structure collapsed, sending one of England's most historic clubs into a decade-long spiral of debt and lower league irrelevance. In the U.S., a single scandal or a stadium deal that falls through can turn a trophy asset into a massive liability overnight. The true payday, however, isn't found in the yearly cash flow or the tax breaks. It's the exit. When an owner finally decides to sell, they aren't looking for a return on operations. They are looking for the massive capital gain. Selling a team is like selling a rare, Picasso that also happens to be the centerpiece of a city's culture. You are selling a guaranteed spot in the global elite. For most owners, the team is the best performing asset in their entire portfolio, consistently outclassing gold, tech stocks, and the S&P 500. Owning a professional sports franchise is the ultimate hedge. It is a business that thrives on fan passion, protected by a monopoly, and subsidized by the taxpayer. It is a world where losing on the field can still mean winning in the boardroom. While we argue about referee calls and trade rumors, the owners are playing a much larger game. They aren't just selling a sport. They are owning a piece of the culture itself. Does a sports team belong to the city that supports it? Or is it just another tax-deductible asset for a billionaire's portfolio? Tell me in the comments if you think the roster depreciation loophole should be closed or if it's just part of the price we pay for professional sports.